Welcome back. If you're a California resident, you know that the cost of everything is rising, from gas to housing. But did you know you could be overpaying for your life insurance by hundreds or even thousands of dollars every year? Today, we are diving deep into a 10-minute masterclass on the best 7 life insurance policies in California for 2026 and showing you exactly how to save at least $500 on your premiums. Before we break down the list, make sure to subscribe to our channel and turn on notifications. We specialize in helping Californians navigate complex financial markets with ease. Now, let's look at the current state of insurance in the Golden State. As we move through 2026, the California insurance landscape has shifted. New regulations under the Sustainable Insurance Strategy have modernized how rates are reviewed, but they've also brought unique challenges. With the average premium sitting around $668, strategic shopping is no longer optional, it's essential. Why $500? Because most families are overinsured in the wrong ways. They pay for expensive, whole-life features they don't need, or stick with outdated policies that don't reflect today's competitive rates. Our goal is to reclaim that money for your pocket while keeping your family fully protected. Number 1 on our list for 2026 is Protective Life. They have consistently topped our rankings for overall value, particularly for their Classic Choice Term product, which offers incredible flexibility. What sets Protective apart is their 40-year term option. Most companies stop at 30. By locking in a low rate at age 35 for 40 years, you avoid the massive price hikes that usually hit when people try to renew coverage in their 50s or 60s. Here's a California-specific saving tip. Protective's partnership with Costco can reduce your premiums by up to 15%. For a standard $500,000 policy, that can be your first $50 to $75 in annual savings right there. At number 2, we have Legal & General, which many Californians know as Banner Life. This is the top choice if you have a high-value mortgage in areas like the Bay Area or Los Angeles and need significant coverage. Their Op-Term series is the price leader for healthy individuals. For a healthy 40-year-old male, a 20-year term for $500,000 can cost as little as $28 a month. Comparing this to a whole life policy could save you over $4,000 a year. They also offer an extended conversion period. This means you can shift to a permanent policy later in life without a new medical exam, providing a safety net if your health changes, but your need for coverage remains. Number 3 is Mass Mutual. If you are looking for a company that will absolutely be there 50 years from now, Mass Mutual's A++ superior rating from AM Best makes them the gold standard for stability. Because they are a mutual company, policyholders are members, not just customers. This means you may be eligible for annual dividends. While their whole life products are premium, their term rates in California for 2026 have become incredibly competitive to win your business. Mass Mutual agents are specifically trained to help with term laddering, a strategy we will detail later. Using their dividends to offset your future term premiums is another sophisticated way to reach that $500 savings goal. Next is a home state favorite, Pacific Life, based in Newport Beach. In 2026, they are the undisputed leaders for those who want coverage fast without the hassle of a traditional medical exam. Their predictive underwriting allows many healthy applicants to bypass the medical exam entirely. You can get a decision in minutes rather than the traditional 4 to 6 weeks, with rates that are surprisingly close to fully underwritten policies. For a 40-year-old female, a $500,000 policy averages about $39 a month. That's top-tier protection for the price of a couple of lunches in LA. Coming in at number 5 is Transamerica. They have carved out a niche as the most budget-friendly option for young California families who need long-term security. Transamerica is famous for their 25-year term. For most homeowners, this is the Goldilocks length. It covers the bulk of your mortgage, but is 40% cheaper than a 30-year term. Choosing this could save you over $200 a year alone. By opting for $26 a month instead of $45, you keep nearly $230 in your pocket every year while still protecting your home during your peak debt years. At number 6, we have Mutual of Omaha. This is the premier choice for Californians aged 45 to 85 who are looking for guaranteed acceptance and simplicity. These policies are designed for final expenses rather than income replacement. They provide peace of mind that your funeral and final bills won't fall on your children, with a coverage range from $2,000 to $25,000. Mutual of Omaha is known for its high claim time clarity. In a state with strict 2026 transparency regulations, knowing that your beneficiaries will have a smooth, clear experience is worth its weight in gold. Finally, number 7 is Ethos. Ethos isn't your traditional insurance company. They are a tech platform that uses predictive analytics to find you the best policy in minutes. For the tech-savvy Californian, Ethos is perfect. Their application often takes less than 10 minutes online. They are also our top recommendation for indexed universal life policies if you want a savings component with a simplified process. Ethos uses advanced data to assess risk instantly. This means fewer people are sent for medical exams and more people get approved at lower rates than they might find through traditional manual underwriting. Now that we've covered the best providers, let's get into the heart of this masterclass: the 4 specific strategies that will save you $500 or more every year. Strategy 1 is the most powerful. It's called the ladder strategy. Instead of buying one massive $1 million policy for 30 years, you split your coverage. For example, buy $500,000 for 10 years to cover your kids until they graduate, and another $500,000 for 30 years for the mortgage. When the first policy expires, your total premium drops significantly. This strategy alone saves California families between $400 and $700 per year compared to one large long-term policy. Strategy 2, pay annually. Most California insurers, like Banner and Protective, offer a discount of 8 to 9% if you pay the entire year at once. On a standard policy, that's an easy $50 to $100 saving with zero effort. Strategy 3, bundle your coverage. In California, home and auto rates have skyrocketed in 2026. Bundling life insurance can trigger a loyalty discount on those policies, effectively making your life insurance 15% cheaper or even free in some cases. Strategy 4, opt for pure term coverage. Many agents push whole life because of its investment component, but for 90% of families, term life provides the exact same protection for a fraction of the cost, saving you thousands every year. Don't forget California's 2026 transparency laws. You have a 30-day free look period. This means you can accept a policy, review the fine print, and if you find a better rate elsewhere, return it for a full refund. No questions asked. Insurance Commissioner Ricardo Lara's latest strategy ensures that insurers are under more scrutiny than ever. This prevents excessive billing and ensures that the rates you see are justified by the state's current economic conditions. So how do you start? Step 1. Calculate your total need. Add up your mortgage, your annual income for 10 years, and your children's future education costs. That total is your target coverage goal. Step 2. Compare at least 3 of the top 7 companies we discussed today. Rates vary wildly based on your specific health and age, so getting multiple quotes is the only way to ensure you are saving that $500. Step 3. Apply our savings tips. Ask your broker about laddering and annual payment discounts before you sign. These are often not offered unless you specifically ask for them. Before we wrap up, let's cover 3 costly mistakes many Californians make that destroy their savings potential. Mistake number 1, waiting too long to buy. Life insurance is a buy young product. For every year you wait, your premium increases by 5 to 8% on average. Locking in a rate now is the best gift you can give your future self. Mistake 2, buying too much term. If your mortgage only has 15 years left, don't buy a 30-year policy. Match your coverage length to your debt years to avoid paying for protection you don't need. Mistake 3, ignoring living benefits riders. In 2026, many California policies allow you to access your death benefit while you are still alive if you are diagnosed with a critical illness. Missing this rider is a huge missed opportunity for security. To recap, pick a top-tier provider like Protective or Pacific Life, use the laddering strategy, pay your premiums annually, and always take advantage of California's 30-day free look period. Following these steps ensures you protect your family while keeping $500 or more in your pocket every single year. If this guide helped you save money today, please support us by liking the video and leaving a comment with your thoughts. And if you haven't yet, subscribe for more expert California financial guides. Thank you for watching, and we will see you in the next one.